For tax purposes, a partnership agreement is broader than the document titled Partnership Agreement. It's any written document or oral understanding that affects the partner's economic deal, especially how income, loss, deductions, and credits get allocated. On the EA exam, they love this because it means side documents can quietly change allocations, even if nobody updated the main agreement. So, what kinds of documents can count? Think anything that changes who bears the risk or gets the benefit. Loan and credit agreements, assumption or indemnification agreements, subordination agreements, loan guarantees, even correspondence with a lender about loan terms. If it changes the economics between partners, it can be part of the agreement for allocation purposes. Next is the timing rule for modifications. Yes, you can modify a partnership agreement during the tax year, but there's a hard stop. You can't modify it after the due date for filing the partnership return for that year, not including extensions. That "not including extensions" phrase is the trap. Filing Form 7004 may extend filing time, but it does not extend modification time. Here's the real-world version. Pierre and Rodney run a calendar year partnership and want to add an accountable plan so the partnership can reimburse business mileage. Great idea, but the agreement change must be in place by the unextended due date of the Form 1065. For a calendar year partnership, that's March 15th. If they extend the return, they still don't get extra time to adopt that change. Exam tip. When you see special allocations, like 20/80 until capital is recovered, then 50/50, your brain should jump to, does it reflect the underlying economic arrangement? The agreement is where those allocation provisions live, and it can include side documents. The test angle is usually, what counts as the agreement, and whether a last-minute change is timely. With regards to the Centralized Partnership Audit Regime, or CPAR, which statement is true? Is opting out automatic under 100 partners? Are only partnerships over 100 partners subject to it? Or, unless the partnership makes a valid opt-out election, do the CPAR procedures apply? Think about what the default rule is. The correct answer is, unless the partnership makes a valid opt-out election, the CPAR audit procedures will apply. CPAR is the default regime for partnerships. A tempting wrong choice is the idea that being under 100 partners automatically avoids CPAR. It doesn't. Opting out requires a valid election and meeting the requirements. Which type of income earned by a partner is not considered earnings from self-employment? Think about guaranteed payments, ordinary business income, and separately stated items like interest. The options include guaranteed payments to general partners, distributive share of interest income, guaranteed payments to limited partners for services, and distributive share of ordinary income. Think about it. The correct answer is the partner's distributive share of interest income from the partnership. Interest is separately stated portfolio income, not self-employment earnings. The tempting wrong answer is ordinary income, because some partners, like limited partners, may avoid SE tax on certain amounts. But the question asks which type of income is not SE income in general, and interest is the clean exception.